hope you're doing well. This is Drew, Creekmer Wealth Advisor with Creekmer Wealth, and today I'm doing my first solo flash briefing of the year with everyone, and excited to kind of walk through what's going on in the world right now and talk about how it relates to your financial plans and to your investment portfolios. But before I do that, I think I need to start with something that me and John have talked about a lot recently. And if you've worked with us in any capacity for a number of years, you know this. We don't allow our personal politics, our personal opinions about things to impact the advice or the information that we pass along to our clients. It's our job to filter out all the noise to allow us to make decisions that are based in facts and data that ultimately are in your best interest no matter what is going on in the world. But that said, let me say that what's going on in Ukraine is incredibly sad, and it's something that we hope that there is a quick resolution to. That's something that we never want to see, and it's a really, really sad and difficult thing, I think, for all of us to see. And it's kind of extremely concerning to see the Russian government invade Ukraine and see a lot of people suffering right now. And so hopefully there's a quick resolution to that. But that said, it's time for us to kind of dive into what is the impact. I know people are concerned about how their financial decisions are impacted, about how maybe some things are going on in their life personally may be impacted by events that are happening overseas. And on top of that, we already were in a stock market correction going into this event, and we know there are some very large economic factors at play right now with 40-year high marks in inflation and actions being taken to address that inflation. And so it's really critical that we have a conversation about what is happening. Let's dive into the data, let's dive into the history, and let's talk about what we need to do, if anything, to ensure that you're able to achieve your goals and you're able to live the life you want to live when you want to live it, which ultimately that is our job here at Creekmer Wealth, is to help you do that. And so let's level set just where we're at going into February 23rd in the markets. And so from Jan 1st through February 23rd, the S&P 500 was actually down 11.16%. This means that we were officially in correction territory in the S&P. That is down 10% in a period of time. And so we actually were already in that correction going into Russia invading Ukraine. The NASDAQ was actually close to a bear market and actually was down at one point pre-market in a bear market, which is down 20%. And so that's that orange line there on the screen. From January 1st through February 23rd, we were down over 17%. That blue line in there is the Russell 2000. That's an indication of all 2,000-ish publicly traded companies. It was down 13.25%. And so that's what the index is. That's where they were at going into February 23rd. Now, keep in mind that indexes are market cap weighted, meaning that the largest companies by market capitalization make the largest percentage of the indexes. And so we right now have some massive companies, Apple, Amazon, Google, that really make up a massive percentage of these indexes, north of 20%. And so if those company stocks are performing well, then the indexes perform quite well. And so looking at the index's performance doesn't tell the whole story. If we dive underneath the hood of the indexes, you'll see the carnage was actually much higher in those indexes. Over a certain percentage of those companies were already in a bear market going into this year. And those were really high growth, high beta companies. Think companies that aren't making a lot of revenue right now, but are rapidly increasing the amount of money they're making. Those companies have really, really been crushed, some down 50, 60, 70% since November. And so it's important to recognize that we were already approaching a bomb in the market. And I saw a great example that kind of illustrates where we were at in the market. And we've all pulled a rubber band, right? We've all pulled a rubber band back, and you have to kind of get in there and pull harder and harder the further you get. But the more you pull that rubber band back, when you let go, the harder it snaps back. And so markets are very similar type of environment. The more markets get sold, the more the rubber band is pulled. And then whenever the markets finally reach a bottom, they tend to snap back really quickly. And I really like this chart because it's a great illustration of where we're at over the last 10 years. And what that orange line is, that's a market correction. The red line is a bear market. And what you'll notice is there's very few times over the last decade where we've actually breached that orange line. And there's even fewer times where we've actually breached the red line, a bear market. But historically, those are great buying opportunities. And so we actually have breached that orange line in the S&P. we were getting close to that red line in the NASDAQ. Those are not the moments in time when you should be selling or moving out of stocks and moving to cash. Those are the moments in time where you should be buying, because historically, no matter how bad it seems, that is when we know we are getting close to the market correcting and moving up and forward. And so what we know, I think, is a great example is what happened yesterday. It's a great illustration of that rubber band. Markets, the NASDAQ was down over 3%. The Dow Jones, the S&P 500 were down over 2% on the news that Russia had invaded Ukraine. However, intraday, as more information came out and as more sanctions came out, we saw an incredible snapback in the market, where the NASDAQ actually ended the day up over 3.3%. The S&P was up around 1.5%. The Dow Jones was actually positive on the day after it fell 800 points at the open. That is an incredible snapback. So had you saw the news and said, I'm done with this, I'm moving out, it's been a terrible, brutal month and a half in the markets, this is just too much, I think it's going to go real bad, and you sold, you would have ended up missing an incredible potential return in the midst of what was a horrible, horrible day, politically, personally, from a news standpoint. It was just a really disheartening day. And so I think it's really important to recognize some other past geopolitical events or just large events. And these are black swan events. And me and John talked about black swan events on Tuesday. I would encourage you, we're going to include that email, that video, and just some other information in this text. We would encourage you to watch that video. It goes deeper into what black swan events are and how you should navigate them from an investing standpoint and how we navigate them from an investing standpoint. But let me just touch on some events here. I think the Gulf War, 3-month war in the 1990, where the S&P 500 was actually down almost 20%, almost in a bear market, but 12 months later, it was up 29%. We have the tech bubble, 2000 to 02. The U.S. stocks were down almost 50%, but 12 months later, they were up 33%. COVID is another example, where we were down 33%, but then 12 months later, we were up 77%. Now, that's a unique situation, and it is partially responsible for what's going on right now in our economy and in our markets. And the digestion of all of the monetary and fiscal stimulus that has occurred over the last 2 years is a large reason for the volatility in the market sell-off that we've seen from January 1st through February 23rd. And so it's important to recognize, though, that those events led to some significant selling in the market. However, if you had just stayed invested and had a good plan going into those events, you would have been okay. I really enjoy this illustration. It shows what your return would have been if you invested $100,000. And over the last 20 years, if you had invested that money, you would have over $616,000. But what's interesting is over that time period, within 1 month of the 24 worst trading days during that time period, we had the 25 best trading days. Again, remember that rubber band. Whenever markets get stretched, they tend to snap back really quickly. And so if you just missed 10 of those best 25 days, your $100,000 would have grown to $282,000. If you missed all 25 of those days because you said the pain wasn't worth it and you sat out and you sold and you went to cash, your $100,000 would have only grown to $134,000. And so it's really, really important that 1, you have a plan, and 2, you allow your plan to work, and 3, you manage your emotions. And it's the hardest thing to do when it comes to investing because these are your hard-earned dollars that you're putting a lot of time and effort into gaining, and then you're investing those dollars, and it's really hard to see them. Sometimes it feels like they're floating away, and that's really painful. But it's important, if you know you have a good plan, that you allow that plan to work. Because where you really make money from an investing standpoint is during those periods of extreme volatility, and it's making sure that you fight those emotions. And so I really want to highlight what we've done. We had a feeling this was coming, so we made adjustments in November. We made further adjustments in January. We had a feeling that we knew inflation was at a 40-year high, and the Federal Reserve was going to need to address that. And so we had made changes in our client portfolios to ensure that we were investing not in high growth companies, but in quality companies that make a lot of money. They pay a good dividend. They have a competitive moat. They're companies that are insulated somewhat against extreme market volatility in a high inflation, rising interest rate environment. Additionally, we have hedges in place that as long as you hold the hedges for 12 months, they will protect you against a certain percentage of market loss over that time period. And so there'll be some volatility in the pricing of those hedges, but as long as you hold the hedges, they will help protect you against loss if there is a loss over a 12-month time period. Additionally, we own funds that if certain metrics in the market are triggered, they move a portion of the money automatically to cash. And then they automatically move it back into the market if other metrics are hit. And it's done by computers, not by humans, it's by a computer. And so going into really the first 2 months of the year, we had a lot of protection in place, and performance was where it should be for the amount of risk that our clients were taking. Going into February 23rd, we actually were not down nearly as far as the market, and we actually ended up being up in between the S&P and the NASDAQ yesterday. And so we know from an investment standpoint, our plan is working. Your money's in the right place. There's protection in place, and we know that we're getting close to the bottom of this market selling. And so what are some things that you can do right now to ensure that you achieve your goals? First and foremost, make your Roth IRA or IRA contributions. You have until April 15th to make your 2021 contributions, or you can go ahead and make your 2022 contributions. The other thing that you can do is you have extra cash sitting in your bank account. Keep in mind that cash is earning less than 0.5% and inflation is up at a 40-year high. So your cash is losing purchasing power. Even though it's incredibly difficult to make that IRA contribution or to move cash into your brokerage account, when you're seeing markets fall like this, it is historically the best thing you can do at this moment in time to get a return necessary to allow you to live the life you want to live when you want to live it. And so I would encourage you, use this opportunity that the last 2 months in the selling has provided you to buy stocks at a lower price so that you can continue on your journey to achieving those goals. And so I hope you found this information helpful. I hope we kind of dove through some of the data. And if you have any questions, reach out to us. We'd love to chat with you about it. Watch that video from John and myself on Black Swan events and how to navigate them. And we will continue to execute upon the plan that we have for our clients and continue to provide information to help you make the best decisions to ensure that your future is where you want it to be. So thanks for the time, guys, and we'll talk to you soon.